I've been reviewing my property portfolio recently in light of the COVID pandemic. Over the last year, landlords have endured loss of rents, illiquid markets, and rising prices stopping them from expanding their portfolios.
Rish's stamp duty holiday has been of little use at the lower end of the market, where the 3% buy-to-let surcharge still applies.
There was some help, like the mortgage payment holiday, which I personally took full advantage of, as so many landlords did, and the furlough scheme to help struggling tenants pay rent.
But of the damage done by the lockdowns, how much is reversible with the reopening of society, and how much represents a true body blow to property investing? Luckily, Paragon Bank have done some detailed analysis of the market, which we'll draw on as we go for those of you who love a good chart.
We'll briefly look at how my properties have fared since I started down the buy-to-let path. Plus, we've packed in a boatload of statistics to show what the outlook is like going forwards for British landlords. In doing so, we'll find out whether buy-to-let is still valid as an investment in 2021. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Next time you need to switch energy provider, try out Octopus and get £50 cash back when you use the link below this video. Octopus are rated 4.8 star excellent on Trustpilot with over 50,000 reviews. Check them out.
My property portfolio, performance. I started investing in buy-to-let in 2017, and as of April 2021, I have 4 rental properties. I've been on a journey with these properties, my first 2 being set up as money pumping but stress intensive HMOs before being converted back into single lets in line with my new hands-off philosophy. I've held off on expanding my portfolio over the last year as I focus on diversifying into other asset classes like stocks and on building up a cash buffer to help my transition from an employed wage slave to a self-employed free man.
The average UK property portfolio contains 7.8 properties. As you can see, this is because a minority of landlords own 20 plus properties. The vast majority of people operate in the 2 to 10 houses range. Owning 4 properties is on the border of the minimum needed to get enough diversification to weather a storm like the COVID pandemic. If one tenant stops paying rent, you can get by.
My property investments have had a tough winter, with one tenant paying £200 less each month due to COVID and outgoings of nearly £4,000 in mostly cold weather related maintenance costs. And that's not the end of it. The pandemic has pushed up interest rates on buy-to-let mortgages, so I'll be paying an extra £40 a month on every remortgage.
But returns do not only come in the form of rental profits. What's happened to equity valuations during the pandemic? Well, house prices have absolutely taken off. Not necessarily in city centre flats though, which have seen demand plummet, but at the city limits and into the suburbs, capital gains for landlords have been incredible.
The equity in my portfolio of rentals has gone up by £61,000 since I bought them, the bulk of this increase happening since the pandemic kicked off. That works out at over a 50% growth in my equity, so what the market has taken with one hand, it has more than given back with the other.
How landlords think the market is going. Despite the challenges posed by the lockdowns, landlords still have confidence in the market. In Q4 2020, landlords were asked whether they'd be buying or selling over the next 12 months. As you can see, the responses were fairly consistent with those given before the pandemic.
Of those looking to buy, the most popular buying intention is terraced houses, which are what I invest in. This type of property is in demand right now with working families, as they offer a good amount of space for an affordable rent.
Of those looking to sell, landlords are wanting to offload single flats. The market for these has plummeted due to lower city centre demand as young office workers settle into new working patterns. Maybe to you that's a buying opportunity.
While landlords are fleeing city centres, they are not giving up on all urban locations. By far the most popular area for future investment is still in urban areas, locations such as the outskirts of cities and commuter towns.
While tenants don't necessarily need to live within walking distance of their offices, they still want to live in cities with the transport links and the amenities and culture they offer. For all the talk of a mass exodus to the countryside, this isn't happening on a scale large enough to fundamentally change the buy-to-let market.
What are investors looking for in a property investment? A property investment has both capital gains and rental profits. 77% of property investors list rental yield as a key characteristic, compared to just 40% who cite overall capital gains potential, though 59% are still interested in making a quick buck by adding value. Investors want cash flow over capital growth, so with that in mind, how valid is buy-to-let now for generating good rental yields?
Yield. Average rental yields have remained static throughout the pandemic, wobbling a little initially. At 5.8%, average yield is pretty much unchanged since 2010. House prices may have gone up, but so have rents, at least outside of London. Yields are low, however, in London, with its higher property prices and falling tenant demand due to the recent changes in working practices.
My properties are in Leeds and Manchester, classic rental cities. Getting a good rental yield from buy-to-let is still valid in the regions outside London and the southeast.
Interestingly, the yield that landlords get on their properties seems to be very much tied to their level of experience at property investing. As we suspected, people owning one investment property have far lower yields than anyone else. This is because many of them will be accidental landlords and so will be renting out expensive houses they inherited rather than cheaper investment grade houses that command a similar rent.
But even amongst investors, the rate of return goes up the more properties they own. This might be due to being able to buy units cheaper in bulk, such as whole apartment blocks, or economies of scale getting you cheaper agency and maintenance fees and so on, or simply by refining their investment strategy with each new purchase. HMOs yield even more. The stats say 7%, but I know for a fact that my own HMOs were bringing in twice to 3 times the rental income of a single let and about double the profit.
Tenant demand. Those yields suggest that there are still tenants paying rent despite the COVID scare stories. Let's look and see how tenant demand for rentals has been holding up. The number of landlords who were reporting increased demand for rental housing fell massively at the outbreak of the pandemic in Q1 and Q2 2020, but recovered to normal levels and better in the second half of 2020.
But the recovery in tenant demand is regional. Demand in central London is almost non-existent, with 54% of landlords there describing the market as weak. While the buy-to-let sector is reported as being dead in the capital, outside of London, landlords are rating the market as being quite strong.
But what about capital growth? Capital growth is there and it's strong. According to the ONS, house prices rose by an average of 8% in 2020. It's arguable that this was in part due to the government manipulation of the markets with things like the stamp duty holiday. But at the same time, there was a global pandemic hitting wages and credit lines.
Rising house prices are great for capital growth if you already own property, so I'm quite chuffed about it. But at the same time, inflated prices are a headache for investors planning to buy their next property, or for newbies thinking about entering the market.
But this mindset is short-sighted in our view. Yes, house prices went up this year, but they did for 46 out of the last 52 years and quite substantially. This means that by not buying now, you may miss out on huge future increases. Imagine worrying about the high price of buying in 2002. House prices continue to rise on average 4% a year thereafter.
But will house prices keep growing? There are many opposing forces at play in the property market right now, each one working to either push up or push down the price of houses. Let's look at both camps.
Number 1, upward pressure. Whichever government you vote for, they all seem to be in favour of open borders, which is a good thing for property investors because it creates more demand for rentals, keeping house prices high. Also, young people fed up with living in house shares or with their parents throughout the pandemic should be driven to either rent by themselves or buy their own house. Either way, it encourages house prices to rise as more houses are suddenly required to house the same number of people.
Also, the government massively encourages house prices to rise through their attempts to help first-time buyers. From lifetime ISAs giving first-time buyers a 25% deposit boost, to 5% mortgage schemes, to the stamp duty holiday, the government incentivises the banks to keep lending massive mortgages to more and more people who wouldn't otherwise qualify for them. Their message to the banks is that the taxpayer will take the risk so the banks can take the profits.
Number 2, downward pressure. First up, there's the government's sabotage of the buy-to-let sector. Despite landlords providing a much needed service, They are portrayed as evil and used as a scapegoat by the media for rising house prices, and are an easy target whenever the government wants more tax revenue. Nearly every year there is a change to the rules regarding taxes or regulations, which always goes in favour of either HMRC or tenants, never landlords. This scares off potential investors and drives house prices down.
And house prices could only rise as long as people can afford to buy them. Wages aren't rising fast enough to keep pace with house price growth. Households have moved over the decades from one income to two incomes to compensate, but it can't go to three incomes.
People can't borrow much more either. Maximum mortgage terms are currently 40 years. For our parents' generation, it was 25 years. It probably can't rise any further because people are also buying later in their 30s.
Finally, houses are not only getting more expensive, they are getting smaller. This is called shrinkflation and is a way for house builders to get around the problem of rising prices. But houses can't get much smaller before people stop buying new builds.
So house prices should not be able to keep rocketing ahead indefinitely, but there's nothing stopping them from rising with inflation and keeping pace with wage growth, and that is what we suspect will probably happen.
Buying right. For all the talk of yields and capital gains, your profits will pale into insignificance if you don't buy right. And by this, we mean you need to use a mortgage. If you own property outright without a mortgage, your combined net yield plus capital gains will very likely be less than what you could get in the stock market, and for greater effort and risk.
Of the 7.8 houses in the average portfolio, 3.8 are owned outright and a further 3.8 are owned with some kind of mortgage. The half of rental properties owned outright probably shouldn't be. The handsome yields we looked at earlier don't factor in costs.
For instance, one of my rentals has a net yield after costs of 3.5% before tax, which is what the cash flow return would be if I owned it outright. But by using a mortgage, my rental profits on this house are 11.5% before tax. And we showed that capital gains were 4% on average since 2010. With a 25% mortgage, you would multiply this growth rate by 4 to get 16% capital gains.
Owning property outright might therefore get you a total annual return of 7.5%, and that's before tax. The stock market can get you 8% with zero effort and good liquidity, and you can shield yourself from tax using ISAs and SIPs. While buying property right with a mortgage might make you over 25% before taxes. Even after tax, it's fair to say that buy-to-let is still a viable investment in 2021.
Question of the day: do you still see buy-to-let rental property as a valid investment in 2021? Join the conversation in the comments below.
Thanks for watching. On this channel we'll talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.